This is bad. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Apple just issued a massive warning, and I'm going to show you why what's going on with Apple is telling us that the holiday season is going to be outright disastrous and could send stocks crashing. And is the manufacturing sector starting to bottom? Well, the data says yes. I'm going to show you why for the American worker, things are about to get much worse. And 25 or 50, that's the debate for Wednesday. I'm going to show you why the Fed's going big. Now, let's head over to Bloomberg, where he picked today's story up with the headline: Apple shares slump as analyst warns of weaker iPhone 16 demand. And this is something we've been warning about on the show as we continue to see evidence that households are unable to keep up with inflation because wage growth is slowing down and hours worked are getting cut. And we've made the case that this was going to affect the discretionary side of the economy. And now we're seeing this with Apple's flagship product now seeing a decline in demand, particularly as we know many people always want the latest and greatest technology. The problem here is they can't afford it. And pre-order sales, which began Friday for the phone, have tallied an estimated 37 million units, but that's down almost 13% from last year's iPhone 15 launch, and as a result of weaker than anticipated interest in the Pro model of the iPhone 16. So the question is there an issue with the Pro model, or is the fact that the price point is higher than most people can afford? They still want a new phone, but they just can't afford the extra price to go Pro. I think that's the real issue here, because the demand weakness for the iPhone 16 is not a good sign, particularly since we're heading into the holiday selling season. The risk of a meaningful decline in the shares has risen in a material way. And yet, what do we see with investors? They've been piling into the mega cap stocks, the Magnificent Seven. They believe that we're at the bottom of a bull market and the stocks are going to go higher. We've been warning. The economy is slowing down, and particularly on the discretionary side, here we're seeing evidence of this happening right now, which is telling us that all the data that suggests that households do not have enough money, it's true, and it's now going to start showing up at the holiday season. And the timing of this couldn't really be worse because investors are so bulled up. The last thing they want to see is demand start to go down, because that means stock prices are headed with it. And sure enough, that's what we started to see today. Because when we look at what's going on the demand side of the component, we see advanced retail sales in blue against total compensation growth in red, which is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That's shown in red both on a year-over-year rate of change, and it's very evident that we tend to see slowdowns in retail sales come right alongside the slowdown in total compensation growth. And it makes perfect sense because we know that consumers always want the latest and greatest and newest thing. It's something that Americans love to spend their money on. The problem is when they don't have the money, well, that leads to a decline in retail sales, and then starts to spread into the manufacturing sector and all throughout the global economy. And we can look clearly at the data here where we see a slowdown in total compensation shown in red and retail sales follow it right down. Here we're seeing the evidence once again. And keep in mind, this is not inflation adjusted retail sales, but we see again a massive slowdown in total compensation growth. Retail sales are coming down for Apple as they head into the holiday season. This is a warning sign, not just for them, but for the broad U.S. economy, because if people can't afford a top of line iPhone, what we're going to soon find out in third quarter earnings season kicks off is that all these other companies are facing the same problem as demand plummets, which could send stock prices crashing. And a key takeaway from the report is that consumers are more interested in the base iPhone models during this launch cycle than Pro. The shift could be driven by pricing concerns. I believe that's a big factor in the era of elevated inflation and high interest rates, or because perhaps the Pro models are too large in size. But nevertheless, Apple shares now down more than 3% at the time of filming, taking, of course, the NASDAQ 100 down with it. And this is just a sign to come, because again, we're about to kick off third quarter earnings, and if what investors have expected is companies to tell them that demand is coming back, sales are going to be strong. But right now, what we're seeing from Apple is that sales are down, and this is going to come and shock again investors all around the world, because this isn't just an Apple specific problem. It's the fact that U.S. consumers are out of money. And what this means for corporate profits is they're heading down as we again look at advanced retail sales now against corporate profits. That's shown in red, both on a year-over-year rate of change. And investors have been really focused on the fact that profits and earnings are going to go sky high, and yet where retail sales go in blue tells us where profits are going. Apple now raising the red flag, and all this turns out to me is we're likely to be facing a stock market that's going to head lower into the holiday season as we go back now and compare the NASDAQ 100 to corporate profits, now just shown as profits, not on a year-over-year rate of change. And what we see is slowdown going into the dot-com bubble led to a big crash in stocks as they completely outperformed the fundamentals. You see that happened again going into the global financial crisis. We see it started to happen as we headed into the pandemic, and there we can see everybody came in and bought this dip back in 2023, sent the equity markets higher, and profits barely made a new all-time high, suggesting that investors were expanding stocks at the margin, and it's not based on fundamental demand for products and services. This is a challenge because we're seeing this now start to spread into the manufacturing sector. And this is important to understand because the data right now says perhaps we're seeing a revival in manufacturing, but deep underneath the data, we see danger signs for U.S. labor who is looking for a break here. They need to see a turnaround in the economy. But remember, where sales go, manufacturing follows, and with that, so too does the labor market. As New York manufacturing expands now for the first time in nearly a year, and this would give us the indication that perhaps the Fed's notion that we're going to see a soft landing is here. The reality is we're not seeing that at all. But something that should be expanding, well, that is your trading account or even your investment account as it close of business Friday. Now, if you want to trade against the machines, we have something called a CTA Timer Pro. When the machines get in a deep short position and price moves against them, it flags our report. But check out our success right here. We have 6 open trades going into today. 83% is a win rate. That's 5 of those trades are up. We added 2 new trades that bought at open today on Monday. You got to jump in and see what we did. Now, momentum hasn't turned yet. We don't have a lot of trades here. We had a whole bunch of them, but we got out of these. But if you like to trade momentum like those technical indicators, we do it better. We put the probabilities in your favor in a big way, because if you want to make money trading and investing, you need to tilt everything in your favor. And one thing we've got is a complete back test to CTA Timer Pro. We know which signals are better than others. We're working on the Momentum Timer Pro right now. This data is available to subscribers at no additional charge. And here's the great thing. You get the report. You get the tradable signals, each and every one of them. But I go through and give you my opinion on. This is one of the reasons why the momentum trades, we don't have many, because I don't think they're very good right now. We're waiting for some big setups. I give you the stop loss levels. I track all the trades and returns. I give you a weekly update on where to put your stop levels, and you get a 30-day free trial, and it's 100% duplicatable. You know, you can't do that with other people's reports, but you can with mine. Links in the description below. Start allocating your money where you can make it with the probabilities in your favor, because as we look to the Federal Reserve Bank of New York September General Business Conditions Index, it rose 16.2 points to 11.5, exceeding all expectations, suggesting now it's back in growth mode. And a measure of new orders jumped more than 17 points to 9.4, the highest since April 2023, while a gauge of shipments surged to more than a 1-year high, suggesting that there's a revival in U.S. manufacturing. But hang tight, it may not last, particularly based on what we're seeing from Apple, because at the same time, a measure of employment showed an 11th straight month of contraction, while an index of hours worked expanded at a modest pace. And keep in mind here, what we're seeing is a sacrifice of jobs to give those who are keeping their jobs more hours. This is dangerous, because what it's telling U.S. labor is the pain is not over yet. Despite there's an increase in demand for out of the New York manufacturing base, what it tells us, we have too many workers, and that means more people as we head into the holiday likely to get pink slips. And we can see this very evident when we get slowdowns in retail sales. Well, that means retailers aren't moving inventory. And if they're not moving inventory, well, wholesalers start to back up. And if they back up their inventory, that means order demand goes down. And when that happens across the board for the economy, as you can see leading into the dot-com bubble, a slowdown in retail sales led to a rise in people filing unemployment claims and staying on there, as evident by continued claims. We see that again in the global financial crisis. You see this long slowdown in retail sales and then a buildup of people who are filing unemployment and couldn't get another job. We see that happening now. Many people believe, including the Federal Reserve, that this is it. This is a peak. It's only going to get better from here. But we know that once we start to see the labor market unwind, it's only going to get worse. And what New York is saying here, right out of the Fed survey, is no, we're not in a soft landing. We're still seeing more people hit the unemployment line. When they do that, they lose their spending power. And next thing you know, we're spiraling out of control. Because as we look at the current general business conditions, this is the index for the New York Empire State Manufacturing Index, shown in blue. Again, we're going to look at continued unemployment claims, because when you see a slowdown in manufacturing, well, again, you don't need as many workers. You send them to the unemployment line, and demand from them then falls, and it starts to spread throughout the economy. You can see that happen right around 2019, and look what's happening now. So the question is, will this surge in the data hold? Well, it's unlikely, because we've seen it pop and then get rejected in the months after. The reality here is we're seeing more people hit the unemployment line. You can see the number of employees are still in contraction. We see the August data at minus 6.7, now September data at minus 5.7. We see a minor increase in the employee work week over last month. And this is something we warned about, because as workers get less and less hours, eventually there's pressure on the employer. So what they did is they laid people off. They give those who still have a job a little bit more time on the clock. The problem is it's still not enough to pay their bills, and that is dangerous, because the New York Fed's gauge of prices paid for materials with little change. But get this, an index for prices received by manufacturers fell 1.1 points to 7.4. And what this means is manufacturers cannot pass higher prices onto consumers. They're being forced to get squeezed at the margin, and the tighter their belt gets, well, that's going to lead to more employees hitting the unemployment line. Keep watch for this, but they still remain optimistic, as the 6-month outlook for overall activity increased to the highest level since March of 2022. A sign the state's producers are more upbeat about the economy's prospects. The outlook for both orders and shipments strengthened. The problem is this just hope? Well, based on what we're seeing from Apple, and all it is hope, because consumers are tapped out. They don't have the money to spend, and ultimately, this is going to affect U.S. manufacturers in a big way. But this points to the next question. Is it going to be 25 or 50? I'm saying the Fed's going to go big, but not everyone agrees. As Blackrock warns on bonds, saying the Fed rate bets are overdone, as we continue to see bonds rallying today. The firm's chief investment strategist said speculation that the Fed waited too long to ease and will now be forced to cut at an accelerated pace to shore up the economy is completely misplaced. In an interview with Bloomberg, she expects the Fed will lower rates by 25 basis points on Wednesday. We couldn't disagree more, and I'll show you why. We think the markets are a bit excessive in pricing the depth of the rate cut cycle. The cutting cycle is starting, but maybe not as deep as markets seem to be pricing. She believes that we're going to achieve the soft landing. I believe we're going to have a faceplant of the economy. There's a big difference, because when we look at the labor market, we know, of course, the Fed focuses on the unemployment rate, but let's look at continued unemployment claims, because when the genie gets out of the bottle and starts to affect U.S. workers, their jobs and their income and their hours worked, well, the Fed reacts in a big way. Here we can see as workers hit the unemployment line, stay there. The Fed doesn't just cut at 25. They take big cuts and rapid cuts down. You can see it here again in the dot-com bubble, heading into the global financial crisis, heading into the pandemic, and now we're facing that situation again. We're seeing more workers on the unemployment line. The notion that the Fed will only cut 25, highly unlikely, particularly since we know the Fed focuses on the bond market, and the yield on the policy-sensitive 2-year note traded near the lowest since September 22 on Monday, a rally that doesn't tempt Blackrock, well, but it should. Because here you can see the federal funds rate against 2-year treasury yields. That's shown in red, and we know when 2-year yields collapse, well, it means the funds rate is coming down. You can see that the 2-year yield leads the funds rate each and every time. The Fed can talk about inflation, they can talk about the jobs market. The reality is what they care about is 2-year yields, and they're telling the Fed they're behind the curve here in a major way. And this is important to understand, because the next meeting for the Fed is right before the election. If they go small now and are forced to go go big in November. Could look like the Fed's playing politics and influencing the election. They've got to go big and do it now. And now we turn to the Fed whisperer at the Wall Street Journal, who has this article, The Fed's Rate Cut Dilemma, Start Big or Small. You got to go big because the bond market's telling you, Nick. Powell kept all his options on the table in his speech last month at Jackson Hole, Wyoming. It surprised some of his colleagues with his unambiguous call to turn attention to the implicit risks of the jobs market. It has to be because Fed Chair Powell knows what happens here. He knows when the job market starts to go, there's more people at the unemployment line, they lose spending power, and next thing you know, their lack of spending leads to more people losing their job. He gets this. The direction of travel, Powell said, is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. And we know the bond market is telling the Fed the risks are squarely to more people losing their job. I'll show you that chart here in a moment. But alternatively, the officials could conclude that if they expect a 50 basis point move is likely in November or December, they ought to make that move now when rates are farthest from their ultimate destination. And that's true, especially again, could you imagine as Fed did 25 and right before the election came out and did 75 basis points? Again, I don't know what the outcome of the election is going to be, but I can tell you whoever doesn't win the election is going to say perhaps the Fed was influencing this. Look for the Fed to go 50 here and then talk up a potential 50 for November if necessary. They're going to make it very clear they need to do that to make sure that they're not influencing, of course, the vote. And a larger cut would lead markets to mistakenly assume the Fed plans to cut rates by the same amount it means in November and December. Well, that's likely the case because that's what the Fed does. It will set up an expectation they would go very rapidly to a neutral level of interest rates designed neither to spur growth nor slow growth. This from James Bullard, the former president of the St. Louis Fed. Of course, we know, Mr. Bullard, that the Fed does cut rates, and when it does, it cuts it rapidly because now let's take a look at the unemployment rate against two-year Treasury yields, and I want you to see what the bond market is telling the Fed is this is it. It is starting to fall apart because look what happens when two-year yields collapse. It isn't bullish for the economy, at least to more Americans hitting the unemployment line, because what we know is that falling yields lead to tighter financial conditions. Less money in the system means there's less money for demand, as we see with the iPhone 16. When you have less demand, that means people lose their job at the manufacturing level, at the retail level, and next thing you know, everything blows apart. You see that heading into the global financial crisis. You see the beginning of it going to the pandemic, which is why the Fed cut rates, and now you see it happening. And again, Powell knows that where the two-year yield goes, the unemployment rate is going to skyrocket, and all the data he needs to go 50, and watch him signal that he's going 50 in November and possibly December. We'll see what surprise he's got for the markets on Wednesday. We think there's going to be an announcement on QT coming. We'll find out then. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.